Welcome to an intro lesson on income tax mathematics. Before the start of the American Civil War in 1861, most of the country's revenue came from tariffs on trade and excise taxes. However, this fell far short of the high cost of the war. Because of this, the federal government enacted the nation's first income tax with the Revenue Act of 1861, which created the Internal Revenue Service, or IRS, as we know it today. No one likes paying income tax, but it is a reality of life. It's also important to note that the U.S. tax code may change from year to year. This lesson will include examples of how taxes, deductions, and exemptions might be computed. In general, your income drives how much you pay in taxes. The more you earn, the more you may have to pay. But your income alone is not the full story. When you add all the money you earned from your job, freelance work, interest from savings, and other sources, you have what's called your gross income. If you are an employee, your income from your job will be reported on a W 2 form, which is sent to you by your employer. Income from freelance work will be reported on a 1099 miscellaneous form and is sent by the company that paid you. Income from interest is reported on a 1099 interest form and comes from the entity that paid the interest. Because of this, it's important that these entities have your current address so that you're sent the important information at the end of the year. Before you determine how much you owe in taxes, you will make certain adjustments to that gross income. You will deduct or subtract some income from the gross income. After the deductions from your gross income, you have what's called your adjusted gross income, or AGI. That is still not what you were taxed on. Next, you need to apply exemptions to your income. These are pieces of income that the government does not tax. After this is done, you reach your taxable income. So to review, gross income is all the money you earned or total income from your job, freelance work, interest from savings, and other sources. Adjusted gross income, or AGI, is your total income or gross income minus deductions or adjustments to your income that you are eligible to take based upon the current tax law. Examples might be money deposited into tax-deferred investments, mortgage interest, some charitable contributions, medical bills over a certain amount, property taxes, and so on. An exemption to income is a dollar amount that can be deducted or subtracted from an individual's total income, thereby reducing income that is taxed. Examples of exemptions might be a portion of retirement income, some academic scholarships, child support payments, and so on. Taxable income is the portion of your gross income used to calculate how much tax you owe in a given tax year. You will notice that your paycheck already has taxes taken out of it. Your employee will withhold some of your income, sending it directly to the federal, state, and local governments. It is an estimate of how much you will owe in income tax. In the end, these prepayments are applied to the taxes that you owe at the end of the year. If they withhold too much income, or more than you owe, you will receive the extra money they withheld in the form of a refund. And now to look at some examples. Roger is preparing to do his taxes. During the year, he worked two jobs with a reported income of $27,500 and $43,200. He has two CDs yielding $327 together in interest income. He also won a club raffle of $2,000. What was Roger's gross earnings or gross income? Recall, gross income is all the money Roger earned or total income from his job, freelance work, interest from savings, and other sources, which means in this case, Roger's gross income is equal to, again, his total income, which in this case is the sum of $27,500, $43,200, the CD interest of $327, and the club raffle of $2,000. Roger's gross income is $73,027. For the next example, Veronica's gross income is $68,529. She deposited $3,000 into her tax-deferred retirement account for the year. Her mortgage interest was $2,550 for the year, and her property taxes came to $4,200. She also donated $500 to a qualified charity. What is her AGI, or adjusted gross income? Recall, the adjusted gross income is the total income or gross income minus deductions or adjustments based upon the current tax law. In this case, we'll assume that $3,000 from the tax-deferred retirement account, the mortgage interest, property taxes, as well as the donation are all deductions. And therefore, Veronica's adjusted gross income, or AGI, is equal to her gross income of $68,529 minus the sum of $3,000, $2,550, $4,200, and $500, which is $68,529 minus $10,250. And therefore, Veronica's adjusted gross income is $58,279. And for our next example, Sam's adjusted gross income, or AGI, is $57,950. She also had a distribution of $2,500 from a health savings account for a qualified medical expense and $6,000 in child support payments. What is Sam's taxable income? Well, the distribution from the health savings account as well as the child support payments are exemptions which can be deducted from Sam's total income. And therefore, Sam's taxable income is equal to $57,950 minus the sum of $2,500 and $6,000, and therefore Sam's taxable income is equal to $49,450. Another piece of the tax puzzle is tax credits. That is money subtracted from the tax you owe. Tax credits are very different from deductions or exemptions. Deductions and exemptions are taken away from your gross income before the tax you owe is calculated. A tax credit, however, is subtracted dollar for dollar from your tax bill. Once the tax you owe is calculated, subtract any tax credits from that calculated tax. Some of the tax credits are refundable. This means that if subtracting them from your tax results in a negative number, you receive a tax refund. And here are some common tax credits. Earned income credit, which is a refundable tax credit for low to moderate income workers. American Opportunity Credit is a credit taken by parents who have children enrolled in college at least half-time and are pursuing a degree. A Lifetime Learning Credit is a credit equivalent to 20% of educational expenses, up to $2,000 per year, subject to income limits. The child tax credit is worth $2,000 per child under the age of 17 if that child lives at home at least half the year, subject to income limits. This is a refundable tax credit. And finally, the Child Independent Care tax credit was designed to help pay for child care when the parents work. The amount of the credit is dependent on your income. Let's look at one more example. Based upon Manny's taxable income, he owes $5,915 in taxes. However, he earned the American Opportunity Credit for $2,500 and a child tax credit for $4,000. How much tax does Manny owe, or how much will he get in a refund? The credits of $2,500 and $4,000 are both subtracted dollar for dollar from his tax bill of $5,915, and therefore the amount Manny owes is equal to $5,915 minus the sum of $2,500 and $4,000, which results in $5,915 minus $6,500, and therefore the amount owed is negative $585, which indicates Manny receives a $585 tax refund. I hope you found this helpful.